Imagine your business as a heart and bloodstream. Profit is the checkup report, while cash flow is the blood actually moving. Both matter, but they measure different things. Profit, also called net income, is what's left after you subtract all expenses from revenue over a period, according to accounting rules. It's based on accrual accounting, which recognizes sales when they're earned and costs when they're incurred, not necessarily when money moves. That means non-cash items like depreciation, amortization, and accrued expenses affect profit even though no cash changes hands today. Cash flow tracks the movement of actual money in and out. It's reported in 3 sections: operating, investing, and financing activities. Operating cash flow shows whether your core business generates cash. Investing cash flow reflects purchases or sales of long-term assets. Financing cash flow covers debt, equity, and dividends. Here's the key difference. Profit is a measure of performance. Cash flow is a measure of liquidity. You can be profitable on paper and still run out of cash. Consider a simple example. You sell $50,000 of products on 60-day credit in March, and your cost is $30,000. Profit shows $20,000 in March. But if customers pay in May, you have no cash from those sales in March. Meanwhile, you pay suppliers, payroll, and rent in cash now. Profit says you're healthy. Cash says you might struggle to make Friday's payroll. The opposite can happen too. Imagine you receive a big prepayment from customers in January for work you'll deliver later. Cash goes up today, but profit may be deferred until you earn the revenue, making profit look modest while cash flow is strong. Why does the gap occur? Timing of receipts and payments, credit terms, inventory purchases, capital spending, loan repayments, taxes, and non-cash expenses all create differences. How to manage the two? Monitor your cash conversion cycle, how fast inventory turns into cash, forecast cash weekly and monthly, stress test slow pay and sales dips, tighten receivables, clear terms, incentives for early payment, disciplined collections. Manage payables, negotiate terms without damaging supplier relationships. Control inventory, right-size stock and improve turnover. Align growth with funding. Use lines of credit or equity to finance expansion. Read both the income statement and the cash flow statement, never one without the other. Profit is your story. Cash flow is your staying power. Master both and you'll make smarter decisions, grow sustainably, and keep your business resilient through cycles and surprises and shocks.